Welcome to the Dough Roller Money Podcast. I'm your host, Rob Berger. Today, in episode 308, we're going to talk about stocks versus bonds. What should your asset allocation be? And I'm going to give you the exact precise, down to the 10th of a percent, precisely how much you should have in stocks and bonds. And if you've listened to this show for any length of time, you know that ain't true. That's not what I'm going to do. But I am going to give you some things to think about as you set your own asset allocation. I do think there are some wrong answers, but I also think there are a lot of right answers. For those watching on YouTube, and I'm picking up my iPhone that's recording this, and I see behind me this ugly pipe that's actually the exhaust for our furnace. I'm working on getting you a better background. I could turn my phone this way, and you could at least see my bookshelf, which I'm showing the folks on YouTube now, for those listening just in audio. But then I would have to turn around my desk. So there's my computer, and I've got this stand-up desk, which I'm trying to show folks as I move my iPhone around. And of course, I've got my chess set with, I now see a roll of toilet paper on it. That doesn't look very good. I actually spilled something the other day, and this was the closest thing handy to clean it up. Hang on, let me get rid of it. All right. So, if you're not listening, if you're not watching on YouTube, it's a new thing that we started a few months ago. And it's actually been kind of fun. But I do need to up my game in terms of what I've got behind me. It looks not so good. So I will work on that. But until then, I'm afraid you're going to have to look at a cinder block wall. It looks like I'm in prison or something. Anyway, such is life. All right. Before we get to stocks and bonds, there is one question that came up in the Facebook group. And if you're not a member, doughroller.net/Facebook group, that will redirect you to the Facebook group where you can join. The question had to do with Robinhood. Robinhood is a mostly free broker. You can buy and sell stocks for free. And they had announced that they were going to open up a checking and savings account that paid 3%. And I remember when I first saw this news, of course, 3% today, this is in December 2018, is well above what the market's paying. I mean, you can get, I know at Ally, I'm getting 2%, I think, on my savings account. And you can probably do a little bit better than that at a couple of places, maybe 2.25%, I think. But that's about the best you're going to get. And they were offering 3%. And so that raised, a bunch of questions. How are they doing this? And my first thought was, is this FDIC insured? That was my very first thought, because Robinhood isn't a bank. And there are actually other investments you can make in certificates of deposit and the like. That are not FDIC insured because they're not from a bank. One example would be certain charities will use certificates of deposit as a way to raise funds, and they pay higher interest rates, but they're not FDIC insured. So in any event, I kind of wondered, how are they doing this? And when I went to the site, and I looked for FDIC insurance, some indication that they were FDIC insured. I couldn't find any. They are, of course, SIPC insured, right? Because they are a broker. But that doesn't apply to checking and savings accounts. So I was, a bit confused. It turns out a lot of other people were too. It was a question that was raised in the Facebook group. And it turns out that Robinhood issued another, a blog post where they're kind of walking back what they did. And here's the deal. As you probably know, FDIC, Federal Deposit Insurance Corporation, insures your money in a checking or savings account and other types of accounts at banks up to what? $250,000. And that's sort of the kind of insurance that I think we all know of. We know it's out there. We hope we never have to worry about it. We hope our banks don't go under, but if they do, we've at least got coverage for more than what most of us would keep in a bank account, I think. But the SIPC, it's a Securities Investor Protection Corporation. It covers brokerage accounts. So think your investments, whether it's a money market or stocks, bonds, ETFs, that kind of thing. If they go belly up or if they steal your money, there's coverage. It's actually up to $500,000, but I think cash type accounts it's limited to $250,000. The problem is SIPC insurance doesn't cover checking and savings accounts, right? That belongs to the FDIC. And Robinhood was promoting a checking and savings account, but they're not a bank. So they're not covered by the FDIC. And SIPC won't cover checking and savings accounts. So there was this issue. And in fact, the SIPC even came out and said, yeah, we got some real questions here. So what Robinhood said was, we're actually, I'll read there's an open letter from their founder. He said, as a licensed broker-dealer, we're highly regulated, certainly true, and take clear communication very seriously. We plan to work closely with regulators as we prepare to launch now they're calling it cash management program, which makes sense. That, Fidelity has cash management accounts, which are basically money markets. Anyway, as we prepare to launch our cash management program, and we're revamping our marketing materials, including the name. Our promise is unwavering. We always put our customers first, whether it's deciding which features to build, keeping your cash and securities protected, or offering products that allow everyone to participate in and benefit from the financial system. So I think we're going to have to wait until they announce a few more things and to understand exactly what this account looks like, exactly what interest rate they're going to pay. Frankly, I would be stunned if they pay 3%, but maybe they will. And we'll find out. And as soon as I know, you'll know. And if you join the Facebook group, you'll know as soon as anybody knows, because it'll be one of the first things posted once they announce. So yeah, there you go. That's the deal there. All right, now we're on to the question, the topic of the day. And I'm pulling up my notes. If you're watching on YouTube, you'll see me look to my right, because that's where my giant monitor is, and that's where my notes are. And the question is today, stocks versus bonds. What should your allocation be? And that question is timely, I think, for two reasons. It first came up in the Facebook group because apparently Dave Ramsey, and it's funny how many issues he kind of raises. In any event, Dave Ramsey had said 100% stocks. That's what you should be in, 100% stocks. Now, I didn't hear that. I'm taking it based on what someone in the Facebook group said. I have confidence that that's accurate, but if I'm wrong, I apologize to Dave, but I've heard that before, so I assume it's correct. 100% stocks. The other reason it's timely is, as you know, the market has not had a very good month so far. We're through 3 weeks of the market in December as I record this, and for the year, the S&P is down, let's see, about 9.6%. So, by no means awful, certainly well within one standard deviation, which we'll talk about briefly in a bit. But it's still down. December's been ugly. And so it's got a lot of people asking the question. In fact, in the Facebook group, one person posted that they got out of the market in September. And the question was, when should they get back into the market? Well, as you can imagine, that created a brouhaha within the Dough Roller Facebook group. So that's what we're going to cover. It's, my thoughts on this are pretty straightforward and I think simple, and I'm going to give them to you. Number one, personality matters, right? If you think about Dave Ramsey, from what I know of him, which is all entirely from what he has, told folks over the years, he is an extremist, right? I mean, he talks about how I guess he filed bankruptcy. I think that's the story, but he got over leveraged in real estate. I think by his own admission, he did really stupid things with money and real estate. The kinds of things that I think, while some people like Dave would do, the vast majority of us would never do that. I can tell you I wouldn't. And it's not because I'm a better investor. I'd be too scared. I'd be too scared to leverage myself to the point that apparently Dave did. I just, I don't have the nerve for it. I don't have the stomach for it. So it's not because I'm a better investor or I'm smarter, or I'm scared. I'm a scaredy cat when it comes to that kind of leverage. I would just never do it. Part of it's my upbringing. There were times when we almost lost our house and didn't have any money, and that affects me and how I manage my money. So he's an extremist when it comes to at least to money, right? We saw that in his story about becoming over-leveraged in real estate. And you see it in his approach to finance today. He's sort of an all or nothing guy, right? You get rid of all of your non-mortgage debt before you invest a nickel. And that means even foregoing a company matched to your 401k. To me, that's insanity. To Dave, that's just the right way to do it. We just disagree. But to me, that's a very extreme view, right? The same thing with the debt snowball. I get the rationale behind it. That's where you when you tackle your debts, when you have extra money to apply to debt, which one do you pick? The debt snowball, you pick the loan, the debt with the smallest balance. The theory is you pay it off faster, and that helps motivate you to keep going. Absolutely valid in the world of behavioral finance, but I always want to say you need to look at the cost, because depending on what debt you have and the interest rates, following that approach could cost you an arm and a leg in interest and take you far longer to get out of debt than the alternative approach, which is sometimes called the debt avalanche approach, which is where rather than putting your extra money to your smallest debt, you put it to the debt with the highest interest rate. But Dave is sort of all or nothing. It's debt snowball. Doesn't matter what your interest rates are. So he has an very extreme dogmatic sort of approach to money, right? And I think that applies to his investing. From what I've heard, you always pay someone to manage your investments. You should not be a do-it-yourself investor, period. And now you should be 100% stocks, period. And so the reason I bring up personality and talk about Dave's a little bit, 100% stock portfolio probably works extremely well for Dave Ramsey. It fits his personality. It fits who he is and how he sees the world, but it may not fit you. Right? I think personality matters. Now, that doesn't mean that just anything goes, and we'll talk about that. It doesn't mean, well, my personality is I should be 100% bonds, therefore that's a good decision. I'm not saying personality drives the right decision completely, but I think it matters. And some people have a personality, like Dave, that can be 100% stocks. And by the way, he's not the only one. I interviewed Rick Ferri. This would have been back in 2013. When the podcast first started. He's written all about asset allocation, which is a great book, and he's actually got a podcast now, so you ought to look that up. I think through the Bogleheads, or maybe I'm not sure, but Rick Ferri's got a new podcast. You should definitely check it out. In any event, I remember him telling me, like, for young folks and his kids, who I think were maybe in their 20s at that time, 100% stocks was the answer as far as he was concerned. So, Dave Ramsey's not alone in thinking 100% stocks is the way to go. He may be alone in the sense that in his sort of dogmatic, this is the right way, and although again, I can't fathom that he would say 90-10, for example, is like a horrible decision. I don't believe that. But he's not the only one that thinks 100% stocks is the way to go, and Rick Ferri is another example, at least for young folks. Point, personality matters, and you need to know where you are, how you handle risk. Would a 100% stock portfolio keep you up at night? If it would, probably not for you. And we'll come back to that idea. But think about your own approach to money, your own personality, what your sort of your likes and your dislikes. What keeps you up? Not just the negative emotions, but the positive ones too. Because positive emotions can get us into as much trouble as negative emotions. So that's point one. Personality matters. I think 100% stocks fits Dave's personality. Maybe it fits yours. Maybe it doesn't. It doesn't fit mine, I'll tell you that. Okay, number two, the question isn't just about math. Certainly you can look back and say over the last 100 years, stocks have outperformed bonds, right? And one could argue then, if you're a long-term investor, maybe not for the next 100 years, but if you're fairly young and you've got 20, 30, 40 years to invest, 100% stocks is the way to go. I think there are a couple of things, that you ought to keep in mind with that, right? Number one, if we take that argument and say it's just math, stocks do better than bonds, we can go to a further extreme, right? Why not just have 100% small cap value? Right? Over the long term, it does better than U.S. An S&P 500 or total market fund. How about just emerging market fund? It probably does even a little better over the long term. How about a leveraged ETF? You can leverage your investments, not personally, but you can buy ETFs that use debt to basically double or even triple the gains or losses on an S&P 500, right? If it's just about the math, and we all agree the S&P 500 has done extremely well over the long term, why not invest all your money in an ETF that either triples your your gains, or on the downside, triples your losses? Now, of course, one could sort of dismiss that as saying, look, even if you like 100% stocks, who has the stomach to triple your losses? Not very many people. Fair enough, but why stop at 100% stocks, right? Why not go to 100% small cap or small cap value or emerging markets? The point is, we can argue that it's just about the math and stocks do better than bonds, but it's not just about the math. And we can take the it's just math argument to an extreme that leads us to, I think, an outcome that most of us could never stomach over a long period of time. I would argue most of us probably can't stomach 100% stocks over the long term. Now, before I go to the next item on the list, one thing to say about that. Let's take Dave Ramsey. Now, I don't know what Dave Ramsey's worth and what he has invested. I'm going to assume he's worth at least 8 figures, tens of millions of dollars. Maybe he's worth hundreds of millions. I don't know. But he's worth a lot of money. I'm going to make that assumption. You get to a point where your allocation almost doesn't matter, you know? I mean, unless he's spending money just wildly, I'm going to assume he's not, then honestly, 100% stocks, 100% bonds, you know, does it matter for him? Probably doesn't matter. And, you know, if you've got $50 million invested and you only spend, let's say, a couple $100,000 a year, I mean, how much do you need to spend to have a good life? Then you're never going to run out of money. And yeah, you could stomach a 50% loss. You could stomach a 90% loss. So 100% stocks, yeah, why not? Particularly if, and again, I don't know Dave Ramsey's situation, but particularly if your goal when you die is to leave a lot of your money to charity, you know, why not maximize it? So, you know, you gotta, it's not just personality, it's just not math, it's also your situation. And that includes more than just how far away you are from retirement. Now, of course, the circumstances I just laid out with someone worth, say, 8 figures probably doesn't apply to most folks. I get it. But I think it's important to kind of see that perspective. All right. Beyond it's not just math, the third thing is, and this is something I don't think people recognize, 100% stock portfolio doesn't always win. Yeah, we can go back to 1926 and we can look at stocks and bonds and say that stocks outperform bonds, and that's true, they do, although you have to talk about which stocks and which bonds, right? There's a huge difference between a 3-month Treasury bill and a 30-year Treasury bond. And there's a big difference between a 30-year Treasury bond and investments in what are called high-yield, corporate debt or junk bonds. And there's a big difference between high-yield bonds from a U.S. company and bonds issued by an emerging market government or emerging market company. And the returns, the historical returns, and the volatility vary wildly, extremely. I'm searching for a word in the bond market. But having said that, 100% stocks don't always win. And that's true over the long term, not just the short term. I mean, there's plenty of 10-year periods where a 90-10 portfolio or even an 80-10 portfolio, or 80-20 portfolio will beat 100% stocks. Now, I went to a site that I like a lot, and it's called Portfolio Visualizer. And I ran a scenario from 1972, which is as far back as their data goes, to the present. Let's think about that. So that's roughly 45, 46 years. So you can imagine someone in 1972, maybe just out of high school or college, they start work, they start investing, and now they're at retirement, right? Yeah, 45 years. You'd be at, in your 60s somewhere, depending on exactly when you started work. And it assumes you start with $10,000, which back then, of course, it's a lot of money now. Back then, it was a huge amount. It also assumes, by the way, these numbers, well, I'll tell you why they matter. The 10,000 number to start with doesn't matter in terms of the return, right? But the next number does. I included in this back test that I ran an assumption that you continued to save each month. Now, I picked $1,000. I could have picked any number. Won't change the return percentages. But I picked $1,000, and I didn't adjust it for inflation. Again, that doesn't affect the return percentages that we're going to talk about, but it does affect the bottom line number. But it's important, and this is a mistake that I see a lot of people make. When you want to look at the returns of an investment over the long term, you've got to factor in an assumption that you're going to contribute monthly or at least annually to the investment. And here's why. I've seen this with American funds. And I forget the name of the fund, but there's at least one fund that I guess has beat the S&P 500 for like 40 years. And the way they quote unquote prove that is they say, well, if you put, it doesn't matter the dollar amount, but if you put a lump sum investment in that fund, whenever it was, I want to say roughly 40 or 45 years ago, and you put the same amount in an S&P 500 index fund, and you just let it sit there till today, The American fund outperformed the S&P 500. The problem with that, so there's no problem with that in terms of math, but there is a big problem with that in terms of reality. Who invests that way? Who gets out of college and puts a lump sum in an ETF or a mutual fund and then never invests again and just lets it ride until they retire? Nobody, right? And the problem is as that fund does well and does poor and goes up and down and up and down and up and down, month after month, year after year, the reality is most people are continuing to invest in that fund, whether it's an S&P 500, American fund, or whatever, and they're going to be investing during good times, investing during bad times as they make their 401k contributions each month, each paycheck, as they make maybe IRA contributions, once a year, once a quarter, whatever you do. And those numbers matter. They affect the ultimate return of your investment, right? So it's important to look at the history of any investment with that assumption included, or you're going to get results that, while not irrelevant from a sort of an academic perspective, they are irrelevant, I think, or can be misleading when you try to apply it to your personal life, because we don't invest that way. We don't put a lump sum in the market when we get out of high school or college and just let it sit there for 45 years. So anyway, contribution amount each month, I made it 1,000. Again, the amount doesn't matter in terms of returns. And then I tested 3 portfolios. One was 100% U.S. stock market. One was 90% U.S. stock market, 10% long-term treasuries. And the other one was 80% U.S. stock market, 20% long-term treasuries. Which one do you think did best, and by how much? Well, it does turn out, given these assumptions, now this is over what, a 46-year period, Portfolio 1 did the best, 100% stocks. By how much? Well, its overall return was just a couple of basis points difference. The portfolio ended up with, both portfolios, the 100% stock and the 90-10, ended up with over $8 million. And the 100% stock, it beat it, but only by $75,000. That was it, on a more than $8 million portfolio, neck and neck. And even the 80-20 wasn't too far behind. It was another $100,000 or $200,000 less. Now, from that, I suppose one could say, well, okay, it's only $75,000 more, which over 45 years in an $8 million portfolio isn't a lot of money. But Rob, it's more, so why not go with that? Well, you can, but you have to understand it's much more volatile. 100% stock portfolio, its max drawdown was 51%. And that was, by the way, in 07-08, probably no surprise there, or 07-09. 51%. You going to stomach that? I don't know. I guess that's, only you can answer that. Now, the 90-10 didn't save you from a loss, but it was 45%. Now, that's still ugly. That's the worst drawdown for the 90-10 portfolio. But it's 6% less. At some point, it's going to matter, right? It's going to make a difference. Only you can really answer when. But the question then becomes, is the difference in the return over 45 years of $75,000 more important than the difference between a 51% loss and a 45% loss? Also, the standard deviation on a 100% stock portfolio is significantly higher. It's over 15%. On a 90-10, it's 13.6. With an 80-20, it drops to 12.3, 12.4. Now, some of you are probably like, your eyes are rolling back into your head and you're about to pass out as you think about, standard deviation. It's a really simple concept. We don't have to worry about how it's calculated. So standard deviation, for those that didn't take statistics or slept through it. I took it actually in college and in law school. They taught statistics, oddly enough. So you think about the average return. Let's just say, we'll make up numbers. We'll say the average return is 10%. With a standard deviation of 5, what you do is you take the standard deviation, you add it and you subtract it from the average. So if the average is 10% and the standard deviation is 5, you'd add 5 to 10% to get you 15, and you'd subtract 5 from 10%, that would get you to 5. And that gives us a range, right? That range in this example is 5 to 15%. You say, yeah, Rob, I got it. I can do that math, but so what? What's that mean? Well, that means that that range is, they'll say it's one standard deviation from the mean. And what that means is about 2/3 of the time, in this case, an investment return, you can apply this to a lot of different things. In this case, an investment return, 2/3 of the time will fall within that range. 5 to 10%. And then you can go out 2 standard deviations. That would mean you would add the standard deviation, in our example, 5%, to the mean twice. So that would take you from 10 to 20. You'd subtract it twice from the mean. That would take you from 10 to 0. And that gives you a range of 0 to 20. And that would be considered 2 standard deviations away, which I think, I'm going to be wrong about this, I think is 95%, but hang on. I got to Google this. 2 standard deviations, yeah, 95%. So what that means is 95% of the time, returns would fall within 2 standard deviations of the mean. And then there's 3 standard deviations from the mean. So that would be what, in my example, -5 up to 25. Virtually all returns would fall within 3 standard deviations. So I hope I haven't lost a lot of you on that. But that's standard deviation. And so, when you look at a standard deviation of 15%, versus 3.5 versus under 12.5, those are pretty significant in terms of your ability to handle the volatility. So having said all of that, you may say, Rob, this is great, but I'm not sure how that helps me. I get it. A 90-10 portfolio might even beat 100% stocks over long periods of time. Over really long periods of time, there doesn't seem to be much difference in the outcome, maybe a little bit in favor of 100% stocks. But it kind of almost seems like, does it really matter at that point? 100% stocks, 90-10, even 80-20. How much does it really matter? And that's a great question. There are wrong answers, but there's no one right answer. And I think this is important. I think it's important when we're making any decision to recognize whether this is the kind of decision where there's clearly one right answer, versus decisions we're making where no, there's actually not just one right answer. And this is absolutely one of them. Are there wrong answers? Sure. I think I would view any portfolio for a long-term investor, and by that I would mean 10 years or more. Anything under 70-30, I would start to have questions with. Could you get away with 60-40? Maybe. But the historical returns on that get to a point where you may have a hard time meeting your financial goals. If you Google returns by asset allocation, the first result is a Vanguard page that shows you the historical returns of various asset allocations. It also shows the best year, the worst year, and how many years of losses. And again, the data goes back to 1926. At 60-40, that is 60% stocks, 40% bonds, you got an 8.8% average annual return. The worst year was 1931, 26%. And it goes on from there. 70-30 jumps to 9.3. 80-20 to 9.6. 100% stocks is 10.3, so it's clearly the highest, but it's also got the most years with losses, 25 out of 92, and it has the biggest worst year by far, 43.1%. The worst year of an 80-20 is all the way down to 35. It's still a bad year, but a heck of a lot different than 43. So I don't think there's one right answer here, and I take comfort in that. So when I'm talking to someone and they insist that there's one right answer, I like to hear why they think that. I don't even necessarily argue with them. I just don't agree with them. There are wrong answers, but there's no one right answer. I think if someone insisted that I give them my opinion as to where I think long-term investors should be, I'd say around 90-10. I think that's a pretty good allocation. It obviously strongly favors stocks. I very well think, certainly over a decade or two, 90-10 portfolio absolutely can outperform 100% stocks, no doubt about it. And I think it could very easily outperform 100% stocks over a 40-year period. I mean, it almost did from 1972 based on the assumptions I mentioned earlier, and with a notable decrease in volatility. That volatility brings me to the fifth point. Whatever you pick, more important than your decision, 100% stocks versus 90-10 versus 80-20 or even 70-30, the more important thing is pick it and stick with it. The mistake we make is trying to time the market and get in and out. That's going to hurt our returns far more than 90-10 versus 80-20. whatever you decide, you absolutely must stay the course. And it's not easy to do that. And it's not easy to do that for a lot of reasons. There's the obvious reason, who likes to lose money, who likes to see their account balance go down. But it's more than that. You hear about like the one gal in the Facebook group. She got out in September, and we all look at that and think, "Man, I wish I'd have gotten out in September. I would have saved a loss of whatever it's been down since then, and then I could just get back in." I guess now, well, I don't know. When would we get back in? See, that's another question. I guess even if you got back in now, and the market went down further, you wouldn't like that, but at least you shaved off some of the loss that other people had to experience. When you hear about these occurrences, when you hear about someone who seemed to get out right at the right time or got in right at the bottom when things started to go up, you get kind of envious. I wish I'd have done that. And that makes it difficult. And then you have financial news where you've got people who predict. I was reading one prediction the other day that we're going to hit a bear market and 2019 is going to be horrible. And of course, they boost his credentials. I forget what, but he'd predicted something else in the past. So he's got to be right about this, right? So you hear about people that have gotten out just in the nick of time. You hear all these pundits, on financial news sites and on the internet who are saying that the market's going to be down, we're going to be in a bear market. And it can fit with your worldview, right? I mean, you could easily paint a negative picture of our market today. You've got the sort of this partial government shutdown, and who knows how that's going to end. You've got the Fed raising interest rates. You got that issue. You've got these trade wars going on with China and others. You've got this whole Brexit thing, which I think for Americans, it's like, well, what's happening over there? I'm not sure. Brexit something. Theresa May's got something going on, and so I don't know. They're all up in arms over there about something, but it seems to affect something, right? And we've had a good market for a long time. It's due. It's time, right? A bear market. 2019 is going to be horrible. And so you get out. The problem is we can be wrong so often. I mean, as I've mentioned, I predicted interest rates would go up like 5 years ago. And the reality is no one knows what 2019 is going to be like. I don't know what the next week is going to be like. And in order for market timing to work for you long term, you have to consistently be right about when you get out and when you get back in. And you can be right about both for decades. And if you're wrong just once, if you're wrong in a big way, you can wipe out the benefit of years and years of being right. Far more important than the specific asset allocation that you choose, be it 100% stocks, 90-10, 80-20, is picking something and sticking to it. And I intentionally don't make certain asset allocation changes, even though I might have good reasons to do it, like I'm getting closer to retirement, when we're in a volatile market, when we're going down or going up in big ways. Because there's part of me that thinks, am I really picking this time because it makes sense for me financially, or am I doing it because I'm motivated by movements in the market? I have one investment in an individual stock that's at a loss. I could sell it to lock in the tax benefits of a tax loss. And I certainly do that with mutual funds that are in my taxable account. The difference is I can get out of a mutual fund, let's say the S&P 500 index fund, and I can immediately put my money into a different fund that doesn't have me run afoul of the wash sale rule, like total U.S. market fund, as an example. But with an individual stock, I can't do that. I could certainly pick the industry it's in and maybe buy an industry ETF. Or maybe I could buy the shares of a competitor, I suppose. But I would have to sit out for 30 days. And I just don't want to do that. Moreover, I have sort of a rule, and I learned this from Guy Spear. I don't make any investment in individual stock that I'm not willing to hold for at least 2 years. And in my mind, I want to hold it for a lifetime. But I won't sell a stock that I bought. I have a 2-year waiting period. So I just bought that. The one stock that's at a loss I bought earlier in 2018. So at a minimum, I won't sell it until 2020. The point being, it's important to stay the course. And I'd rather lose a little money on one investment than start getting into the habit of being swayed by market volatility to make investing decisions. So stay the course. vastly more important than the specific asset allocation you pick between stocks and bonds. Finally, I'll say this. One of the things when I'm preparing a podcast for you guys that I think about is on any issue, what would I tell my children? If my son or daughter came to me and said, Dad, what should my asset allocation be? What would I tell them? And I actually had this with my son. And he wanted to know what to invest in. He has an interest in investing, but not so much the kind of investing we talk about. And so what I told him was target date retirement fund. He has a very good one in his fund where he works, or his 401k where he works. And we put, it was in a Roth 401k, we decided, and all his money goes into a target date retirement fund, which at his age is probably around 90-10, maybe even being 93-7. I can't remember, but it's close to 90-10. And that's what I told him, and I think that's solid advice. Is 100% stocks wrong? Is Dave Ramsey wrong? No, not at all. I don't think 100% stocks is for most people, and I certainly wouldn't say sort of a general rule that's what you should be in. That I think is wrong. But if you've got the right personality and you can stick with it for the next couple of decades, which is I think what you need to do at a minimum, regardless of what you choose, unless you're getting to an event like retirement, if you can stay the course, I think 100% stocks is fine. I just think a lot of people can't. Moreover, I'm not at all convinced that a 100% stock portfolio will outperform, say, a 90-10 portfolio, even over the long term. And I think a 90-10 portfolio, even that 10% in bonds, will take the edge off your portfolio and give you a noticeably less volatile investment portfolio. So that's my view. If you haven't joined the Facebook group, join it. Love to hear what you think about the show, the podcast, your views on asset allocation, stocks versus bonds. Again, you can do that at dorwiller.net/Facebook group. Hey, until next time, remember, the best thing money can buy is financial freedom.